Thanks for joining us on Digging for Value. I'm Allison Southwick. I'm joined today by Mike Olson and Tyler Crow. They're energy analysts here at the Motley Fool. So today we're going to talk about some energy stocks to buy, sell, and hold. And we're also going to have an airing of grievances. But first, to the headlines. Our first story here that comes from the Financial Times. They're reporting that the price of oil is dropping because U.S. and Iran might be talking at the UN. Yay! It's like they're making up. And this is really exciting, right, Tyler?
Well, I think this is kind of the fascinating and insane part of the oil industry right now. It's kind of this intersection of politics and production and all the other things that just seem to go with it. I mean, you could actually, if we could find a photo of President Rouhani and President Obama just kind of skipping out in front of the UN building, holding hands, I'm sure that the price of oil would drop by like $10. It's just absolutely insane. And, you know, I think really when you look at it, this isn't really going to change anything at all for two reasons. Number one, it's a long ways off from anything actually happening. This is just talks, and that would involve actually lifting sanctions on Iran and them actually building out their production again. So it's really hard to see this happening for years down the road. And the other part is Iran is part of OPEC. And, you know, kind of stealing a quote from my favorite movie, The Big Lebowski, this isn't Nam, there are rules here. You know, they have to meet production quotas. And if Iran starts to boost their production numbers, then somebody else is going to have to make a cut because they want to maintain a steady oil price, somewhere right around $100 right now based on what OPEC is saying. So, you know, worst case scenario with these deals or whatever is it's the absolute status quo, nothing changes. Best case scenario, you know, we completely open up to Iran, we allow oil companies to go in. Maybe some companies get some contract work, some of the integrated majors, some of the oil services companies to actually help boost oil production. But it's hard to see really any single company having a deep impact on this.
Yeah, do you have any thoughts on this, Mike?
I mean, I think it's just kind of to Tyler's very point. It just goes to the absolute insanity of what's going on here. Iran has not been a meaningful contributor to oil production, at least as it relates to the U.S. supply picture for a very, very, very long time. And moreover, as he said, all of these OPEC countries are very, very interested in maintaining a certain oil price because if they can't, they just can't sustain their budgets. So whether or not this means anything in the long run, I don't know. But it will, if anything, only be geopolitical, and it will have nothing to do with oil markets.
All right, so for our next story, we're going to go to oilprice.com. Of course, the big news this week has been that the Obama administration is going to put limits on coal plant emissions. And, of course, critics have been pushing back, saying that it's going to raise the costs, and it's cost prohibitive, and it's just the worst thing in the world. So over at oilprice.com, Charles Kennedy is actually saying, asking the question, will EPA's new power plant emission regulations be the end of coal? Dun, dun, dun. So this is obviously extremely big language inflammatory here. Mike, is it the end of coal? Is he right?
This has been roundly misinterpreted, and the reason it has been roundly misinterpreted is the proposed rule only relates to new coal-fired power plants. They've effectively made it cost prohibitive to build new coal-fired power plants. And the reality is that this is kind of a non-headline. Gas-fired turbines with the new technology are substantially better from an economic standpoint. It is interesting, if we're to go ahead and take a longer view, when you start to think about what the Obama administration's proposed rules are going to be on existing coal-fired power plants. I think they're going to take a much more soft-handed approach regarding that. That's 40% of the nation's power generation, and so you can't just go ahead and shut a switch on this. Otherwise, economy kind of stops functioning. When we take a very long view, again, one thing that's interesting, a recent IHS study found that a lot of existing power plants are not earning sufficient enough return on their assets to justify continued investment. And so you have a power infrastructure that's continuously degrading. What I am concerned about, or what you might think about on a longer term basis, is this is going to flow through to natural gas prices because folks are going to start to invest in natural gas-fired infrastructure. It will push natural gas prices up. Consumers are going to bear that cost. Winners in this? I think you got to think the natural gas pure plays are going to win. Chesapeake Energy, Devon Energy, and another one that's interesting is Ultra Petroleum.
All right, well, going over to our final headline, we're going to go to Bloomberg. U.S. producers skip Brazil's biggest oil find. Essentially, 40 companies were expected to compete on this oil find, but they only got 11. And it's some of the big names, Royal Dutch Shell, some Chinese companies, China Natural Petroleum, Petrobrazil, but oil companies were missing from the group, Exxon and Chevron namely. So Tyler, do you think this is a good idea for U.S. companies to sit it out?
I think what it is it's kind of like the words of the 80s hair band Great White. They're once bitten, twice shy with a lot of these collaborative projects. You know, if right now, the Brazilian offshore fields are a major promising field. But because of government mandates in the area, Petrobras has to be the operator on all the fields and have a 30% working interest on everything that's going to happen there. And a lot of these companies, like Chevron and Exxon, have seen collaborations not really go well. And I think two recent ones that are great examples of this are Kazakhstan. In Kazakhstan, we've seen Shell and Exxon and Eni Spa working with the Kazakh National Oil Company. I think 7 years delayed, $24 billion over budget. You've also got problems with companies trying to go into Iraq and help boost production there. Exxon's actually just sold off some of their sections to PetroChina as well, just simply because it's not working out on these collaborative efforts. You know, Chevron has actually even already had some problems in Brazil. Back in 2011, they had an offshore spill, and the government was looking at major penalties, actually expelling them from the country, and billion-dollar fines, very similar to the amount of money that BP was going to pay for the Deepwater Horizon spill, even though it was only a $2,500 barrel spill. So it's very small. They're a little hesitant to work with them. And U.S. oil isn't really looking to grow production for production's sake like a lot of these Chinese companies. They really want a big return. And so that's why we're seeing a lot of these moves away from these collaborative efforts and really trying to do their own thing.
All right, well, that covers it for the headlines. Now it is time for the airing of grievances portion of the show. I am going to give each of you exactly 1 minute to rant about a topic of your choice. Who is going to go first?
I will take the ball. My rant of choice is oil prices and the extent to which they've moved in relation to whatever machinations are in vogue in the Syria crisis. This makes absolutely no economic sense. Syrian oil production is a dwindlingly small percentage of total world oil production, and so whatever happens with them has absolutely no consequence. The only way it might, and I say might, begin to matter is the extent to which this has broader ramifications to how the U.S. will deal with Iran. That, as it stands, is a large question mark.
Oh, you still have 30 seconds to go.
Wow.
Do you want to keep ranting, or are you done? Is there anything else?
I've gotten all of it out.
How was your commute to work today? Was it okay?
It was quite manageable, yeah.
It was efficient.
That was efficient. Nice work. I'm going to start giving you guys only 30 seconds to rant then. All right, Tyler, are you ready for your rant?
I think I am.
All right, and you can use your whole minute or choose to go
You can
under.
take a minute and 30.
No, well,
Yeah,
let's keep
that's
it to a
pushing
minute.
it.
All right, go for it.
All right, since the 1970s, the U.S. has had this arcane ban on exporting crude oil from the United States. Up until today, it really hasn't ever been a problem because we've had to import so much oil, so it's relatively been inconsequential. But thanks to the large boom in shale oil production, rock stars like EOG Resources and Continental Resources, they're bringing on tons of light, sweet crude in the United States right now, and this could actually flood U.S. refiners' capacity for light sweet crude. Now, Deutsche Bank actually estimates that production from U.S. light shale play should be increased by about 700,000 barrels per day between now and the next 12 months. And this would be enough to actually flood light sweet capacity. So unless the United States is willing to lift the export ban, we're going to see a big problem where oil prices are going to drop because we're restricting the market, and it's going to bring the boom to a screeching halt.
Look at that. You
1
got
second to go.
That is
time.
awesome. Way to go. That is great. All right, that's enough for the airing of grievances. We are now going to move on to a little game we call Buy, Sell, and Hold. It's our version of Date, Marry, and Kill. I'm going to give you guys 3 companies in a similar vein, and you're going to tell me which stock you think is a hot little buy right now, which stock is a hold or more like a marriage, and which stock you would want to kill, aka sell. So first, I'm going to start off with you, Mike. I'm going to give you 3 companies that are in natural gas exploration and production.
Okay.
They are Southwest Energy, Range Resources, and Ultra Petroleum. So first off, which one is your sexy little buy right now?
My sexy little buy is Ultra Petroleum, and full disclosure, I do own the shares. The reason I like this company is you have a management that has a stellar history of value creation. They're very shareholder focused. They have some of the lowest cost assets in the business, and they have a huge inventory of drillable acreage.
So then what is your stock to sell?
Stock to sell is Range Resources, and it is not for the reasons that you would think. I don't want to kill them, per se. This is a management team and a company that has a great history of value creation. They have truly some of the best assets in the Marcellus. However, the market is not altogether lost on the market. The stock is extraordinarily expensive, and I just can't make sense of the valuation.
All right, and then finally, which is your stock to have and to hold?
Southwestern Energy, and this is a marriage you stand not so much because you like it, but because you really don't know how to do better. This is a company, they've done an excellent job of dealing with what they have in the fiat bill. This is a play which is not extraordinary on an economic basis, but they've rung efficiencies, they've been very smart about getting their costs down, and they've had a good run of it. The problem is that run really requires $4 natural gas in order for them to continuously earn good returns. The acreage where they can make good returns at $3 natural gas, slowly but surely dwindling, and so I just don't know that the future is going to be as bright as the past.
So a marriage with maybe divorce on the horizon?
Yeah, it's one of those ones you should have stayed in for about 3 years while it was fresh and gotten out.
Right, get out before you have kids. All right, Tyler, we're going to look for you. We're going to look at some integrated majors, AKA big oil. I'm going to give you Shell, Total, and Chevron. So which is your stock to buy?
I think right now the buy for me is Chevron, and one of the biggest reasons that I'm looking at that is because they, of all the other integrated majors right now, they're trying to take control of their future through the operational stake that they're taking in their projects. If you look at their big facilities such as Gorgon and Wheatstone LNG, the Kitimat LNG, as well as their Gulf of Mexico operations, such as the Jack and St. Malo facility, all of them they have at least a 50% operating stake. They're the main primary operator, and if we've seen a lot of projects for integrated majors right now they're struggling because there's too many fingers in the pie, too many people trying to make decisions. We talked about it earlier, places like the Kazagan field in Kazakhstan, the Syncrude project up in Canada. There's just a lot of people trying to make a decision, and it's causing delays, it's causing budget overruns. This way, Chevron's letting people know, we're going to take control of this. And of all the integrated majors, they seem to have figured out shale drilling. They're bringing on about 200,000 barrels per day of oil from the Permian versus a lot of that shale natural gas. Companies like Exxon has kind of struggled with a lot of their gas from XTO Energy buy, as well as Shell's actually looking to get out of the Marcellus right now because of the problems they're having. So I like Chevron and the moves they're making right now.
All right, how about your stock to sell?
Stock to sell, just go at it. Royal Dutch Shell. They just scrapped their production targets because it doesn't look like they're going to be making them right now. They're also having a big problem with their operations in Nigeria, which is a major asset for them. They're expecting about a $12 billion bill relating to things such as theft and sabotage related to a lot of things going on in the Niger Delta. So they're actually looking to sell a lot of its onshore, move to the offshore, and also they're part of that Kazagan project. It really hasn't lived up to expectations. U.S. shale is underperforming. They're looking to sell that as well. And it just really looks like the company's a little rudderless right now, and I'd really like to see a clear plan of attack from the company before I make a decision on them.
All right, and I guess that leaves Total as your stock to marry.
And I think kind of the same thing with Mike here, where I'm not completely sold on buying it, and if I hold it, I'm not going to get rid of it either. It's Total. They have a strong development portfolio. It's about 750,000 barrels of oil equivalent in very high quality projects, because if you look at it, 75% of those are either in oil or oil indexed natural gas, which means they're going to get a much better price on it than, say, some of the spot prices that you're getting here in the United States, which is going to be very beneficial for your LNG projects looking overseas. They're keeping their projects on schedule, which is something that we've seen has been a big problem. So it shows a big plus for them in terms of operational efficiency, excuse me. And I would like to see the company kind of focus on pushing down its debt once a lot of these projects come online. That's kind of one of the things that makes me hesitant about them. They have about a debt to capital of 30.5%, which is the highest among its peers. So that's why I'm hesitant. But if you're already in on Total, they've got the best dividend yield of the peers at 5.8%, so it's certainly not anything you want to throw away.
All right, well that covers it for buy, sell, and hold. In closing, I want to hear about one stock that is on your radar right now. Mike.
Okay, this is one that does not yet exist, actually. National Oilwell Varco, this morning they announced that they are spinning off their distribution segment. I like this a lot. This is a segment that has historically been sort of the hidden gem, the ugly stepchild of National Oilwell Varco. family of companies. It is their lowest margin segment, and it is not really the reason that investors who are in National Oil Wealth Fargo will own the shares. What they do, they basically act as the hardware store for E&P companies. So you need to go ahead, or drillers, you need to go ahead and replace some element of the consumable that wears out. They will go ahead and get it to you. They benefit from two key competitive advantages. A, they're a player of scale, and B, because they are a player of scale, there's kind of a nice little network effect here where customers are more willing to shop with you and vendors are more willing to give you their product. That's resulted in some really good growth within this business. What I would expect is that shares are going to trade down when they eventually do go public, and I would be very interested in this because I think it's an exceedingly high quality business.
Oh, sounds like an interesting potential buy here.
Mm-hmm.
Yeah?
Oh yeah.
Oh yeah.
Mm-hmm.
Okay. All right, Tyler, what are you watching?
So I'm actually looking at Ensco right now. I think when we're looking at the rig operating kind of environment right now, the real industry darling is Seadrill. But what I think a lot of people are kind of overlooking Ensco because they have a lot of the qualities that Seadrill actually has. They have that young floater fleet of semi-submersibles and drill ships, which are less than 3 years old. So they've been able to keep those utilization rates very high. Seadrill say we've had 100% for 3 years, but Ensco's been running at 95% on their floater rig for the past 2 years. Compare that to some of the old kind of traditional ones like Transocean and Diamond Offshore. They're looking at about 85% for the past 2 years. So Ensco has those good qualities, and they're looking to add to their fleet. Certainly not as much as Seadrill, but they're doing it within their cash flow at a much more modest pace versus Seadrill, which is kind of levering up to get that growth. A lot of debt coming on. Debt to capital for Ensco is about 28% versus Seadrill, which is 61% right now. So, why I really like it right now, it's got a strong dividend at about 3%. And despite the fact that it might not grow as fast as Seadrill, it's much, much cheaper. If you're looking at it right now, Seadrill, you're going to have to get in a forward PE of about 13.6 versus Ensco forward PE at about 7.9. So right now, I think that, I'm not saying that I'm against Seadrill, but I'm looking at Ensco just as a value play.
Right, and I think one thing that Ensco has done really well as somebody who's a happy owner of the shares is they have this standardized rig build program where what they do is they have the same design across all of their rigs. So the consequence is that the cost of building those rigs has been much, much, much cheaper than their peers. And they also are able to manage their rig downtime much more effectively. You'll see particularly companies like Transocean have seen a lot of their rigs just spending time in the shipyard. Transocean, because you have a standardized design, they know how to fix them and they know how to keep them going.
All right, well, that covers it for today. For more energy sector analysis, we've got you covered at Fool.com, and you can also follow us on Twitter at TMFEnergy. Until next time, for Tyler Crow, I almost said Taylor, and Mike Olson, I'm Allison Southwick. Thanks for watching.